August was a good month for stock markets around the world. In America, the Nasdaq and the S&P 500 set new all-time highs. The S&P 500 rose by 7%, its best August in over 3 decades, making it 8.3% up since January. The Nasdaq did even better, gaining 9.6% in August, making that a 30% gain overall this year to the end of August.
But the UK's FTSE 100 is dying. It managed a feeble 1% growth in August. Growth is growth, you might say, but look at that overall downward trend since June. And look how the rest of the world performed in August. Only Brazil performed worse than the FTSE 100. And look which country is doing worse of all since the start of the year. That's right, the UK's FTSE 100, followed in joint second worst by Russia and the UK's FTSE 250. So something is clearly foul in the UK market.
Just what is going on? And should we even be investing in the FTSE anymore? Let's check it out.
Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
We have thousands of pounds of offers and bonuses at Unshackled.com, including up to £200 of free shares just for opening an account with free trade, from where you can invest in the FTSE 100 index, S&P 500 index and so much more. Now let's get into the video.
America the Great. A lot of the UK market's woes right now are due in part to America doing so well. America's existence as a technology superpower sucks in all the investment money from the rest of the world as the big technology giants continue to impress. Also, US companies are plowing billions of dollars into treatments and vaccines for COVID-19, making them a target for investors.
The rise of retail investors entering the market after stocks crashed everywhere in March 2020 has helped the US too, at the expense of the UK, as these newbies invest largely in line with company name recognition. Facebook, Apple, Amazon, Netflix, Google, Microsoft and Tesla are all American companies. The UK is boring by comparison and has relatively few companies that anyone could get excited about.
To kick us when we were down, last month the US Federal Reserve announced that they would keep interest rates lower for longer, and said that they didn't care if this leads to higher inflation. This was great news for the US stock market, but the side effect was that the value of the US dollar went down, which had a large impact on the FTSE 100.
Why the dollar matters in the UK? Part of the problem with the FTSE 100 over the past few months has been that as the dollar has weakened, the relative value of the pound has increased. We can see here how the pound has been strengthening against the dollar, but why is a stronger pound a bad thing? It sounds pretty good. Well, here's why.
FTSE 100 companies are not really UK based. The FTSE 100 is made up of large international companies with significant earnings in foreign currencies. Such a large proportion of the profits made in FTSE 100 companies are made in US dollars, but if sterling strengthens, then dollar revenues, once converted back into sterling, are worth far less. This is why we regularly see a rising pound coincide with a falling FTSE.
71% of revenues generated by the FTSE 100 come from outside the UK. That's almost all revenues being in a currency other than the pound. But 97% of FTSE 100 companies are headquartered in the UK and most will report profits in pounds. This means that the fate of the FTSE 100 is inescapably tied to currency movements.
Big international companies have chosen to domicile in the UK because of our fairly stable legal and tax regimes. A fact our government should bear in mind before it starts hiking up taxes on companies to pay for COVID. These companies might make us investors exposed to currency risk, but our economy depends on these big companies staying where they are.
Dinosaur stocks. The FTSE 100 is often described as being full of dinosaur stocks, old world lumbering companies with little to offer in way of growth. The FTSE 100 is full of old industries like retail and oil, industries that could flatline for years to come as the twin problems of struggling global growth and Brexit concerns limit any chance for growth.
What is missing is tech, which is clearly the driving force behind America's success in the last decade. Can you mention a single large cap UK tech company? Answers in the comments section.
The FTSE 100 just went through a reshuffle, kicking out ITV, and it was replaced by B&M, another retailer. We need some more tech. What we do have in the FTSE 100 in large doses is oil companies. Pre-COVID, oil made up around 17% of the value of the index. Since oil crashed and burned back in April, it's now more like 9%.
What this tells us is that the FTSE 100 is unusually exposed to the price of oil. US companies innovate and produce new products for the world to enjoy, while the UK has dinosaur companies which sway in the wind according to how the exchange rate of the pound and the price of oil moves.
What the UK does have, it's not all bad news for the FTSE though. The FTSE is also famous for being home to value stocks. If you want to buy your stocks cheap, then go shopping on the FTSE.
A value stock is a security trading at a lower price than what the company's performance might otherwise indicate, and the UK is chock full of them right now. Companies like ITV and DART, aka Jet2, which we covered in a recent video called Free Stocks Set to Explode, linked to below, are the embodiment of value stocks.
These companies are likely trading at less than half of what their fundamentals indicate they should be priced at. How can that be possible? Well, contrast it with America, which demonstrates the effect in reverse. Tesla is priced at over 1,000 times its earnings, Amazon at 100 times. A so-called normal price earnings ratio might be 15 or so, depending on the expected growth. ITV's PE is just 6.
Property builder Redrow is another UK stock we've both been buying. It has a PE of just 5, a big cash buffer, a 19% return on equity, and an order book for new work after COVID of £1.4 billion, which is up 50% on last year, so it can really hit the ground running. Property building is sure to take off after COVID, airlines too. It is this type of company, hidden away in the UK, that has a real potential for growth.
Think the UK doesn't have any tech stocks? Well, think again. You just need to look a little harder at the small and mid-cap end of the market. We did a video recently called Top 4 UK Tech Stocks, which we've again linked to below, but here's another 2 for you.
Rated excellent on Trustpilot by its customers, email marketing software company Digital has a market cap of just £384 million and has everything going for it. Top rated for quality on Stockopedia, with a solid history of share price growth, a 29% return on equity, top scores for financial health risk, a growing earnings per share, a growing dividend, sales up 14%, analyst consensus. I couldn't help but to buy some.
On the face of it, the only thing going against it is its valuation, which is high at a PE of 31, but it is a tech stock and a good one, so that is to be expected. Find us a tech stock with a low price earnings ratio and there will likely be a reason for that, and it won't be good.
Rightmove is another tech stock winner, and this one is actually on the FTSE 100 with a market cap of £5.5 billion. Its fundamentals are very similar to Digital, but it is far larger, and with it being linked to the property industry, is currently being impacted by COVID.
There may not be much more room for growth for Rightmove, as it is already the dominant online estate agent tool. No one else comes close. They cover the whole UK market and already charge the highest average revenue per advertiser at well over £1,000. Their nearest competitor Zoopla are a long way off at an expected £400. They might have to expand into other countries outside the UK to continue their incredible growth.
How we're investing in the UK. I've reduced my holdings in FTSE 100 and FTSE 250 ETFs, instead choosing to up my exposure to the UK market through investing in individual UK stocks. I've done this because I like to pick stocks anyway, and they all happen to be mostly UK stocks because of my local knowledge, and I don't want to be overly exposed to the UK by investing heavily in ETFs as well.
I've long owned many UK stocks, but bought these based on a buy and hold forever philosophy. I've been improving my investment style recently though, and now see little reason to hold individual stocks long term, when an ETF will more than suffice. With the core of my portfolio being invested in solid, dependable ETFs, I can now focus on the individual stocks that I think will beat the market and base my decisions on a shorter time horizon. I'll be concentrating on both UK and US stocks for the satellites in my portfolio.
There's a lot of crap in the UK stock market which gets scooped up in an ETF, as seen in the decline at index level. So handpicking a select group of stocks that represent the best of the UK might be a more refined strategy. As we've shown, there are some hidden value and tech gems in the UK. A counterpoint against this method of investing is that multiple stocks are difficult to manage if you don't use an advanced investment tool like we do.
You tend to get what you pay for, and the free websites tend to be free for a reason. If you don't have access to a good information website like Stockopedia, it might just be best to stick to ETFs. Also, the time investment of analysing stocks might not be worth it if you haven't got a large amount to invest.
If I wasn't stock picking, I would continue to hold around 10 to 15% of my portfolio in UK ETFs, even though they are performing poorly currently, because they pay very good dividends and they are also very, very cheap.
Don't forget we have a discount for Money Unshackled viewers for 25% off an annual membership to Stockopedia with a 14-day free trial, linked to below. Question of the day. Do you think that the FTSE 100 will outperform other markets over the next few years? Let us know in the comments section. Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.